Yo, what's going on, everybody? So in this video, all we're simply going to do is talk about the moving averages and the RSI. So when it comes down to the moving averages, really I only use them to determine what side has more volume. So really quick, when it comes down to the moving averages, what you want to do to add them onto your screen is go and press indicators. You're going to type moving, or actually you could type simple, and I misspelled simple. You're going to type simple and you're going to see simple moving averages, which you could just select it and you'll see them added to your chart. Now, every moving average is going to be different, right? So all you're simply going to do is come into settings, go to style, and you're going to turn off every other moving average. That's not there. We're only going to need 2 moving averages, right? Now, what you're going to do is make one of the moving averages blue, and you're going to make the other moving average red. So let's just put this color for now. Then you're going to go to inputs. So SMA 1 is going to be blue. So what we're going to do is go to inputs, and we're simply going to make this a 21 moving average, and we're going to make this close. SMA 2 is going to be red. So we're going to go to SMA 2 here, and then this is going to be a 50 moving average, and you're going to press close. And as you guys can see, we have our moving averages here on the chart. Now, what we need to know about the moving average is all we're simply going to be determining is what side has more momentum. So typically, if the price action chart, or if your candlestick analysis, well, not candlestick analysis, but your price action chart and the candles are trading above the 21 SMA, then typically you're going to be in a bullish trend. And remember, the higher the time frame, the more the reliability, right? Now, if your price action chart breaks under the 21 SMA and the 50 SMA, and the price action chart and the candlesticks are trading under the 50 SMA along with the blue SMA, then most likely you're going to be looking typically to go short because there's more bearish volume. So again, when price is trading above both SMAs, you're typically looking to buy because there's more bullish volume. When price is trading under both SMAs, you're typically looking to sell because there's more bearish volume. So what you could see is here we have price trading above both SMAs at this point in time, and price kept making higher highs. Now over here we started to see a small transition, right? There's going to be times where price breaks under the moving average per se, like here, and price is trading under the moving averages. You always want to check with the daily and see what the daily is doing. So you know on the daily you're trading under the 50 moving average. The 50 moving average is going to be our 50-day trend. That is going to be our stronger moving average. So if price breaks under the 21 SMA, you still could be potentially in a bearish trend, just you're looking for more of a steeper pullback. Now, one thing I want to mention about the SMAs also is that you could also kind of look at them for areas to go long or for areas to go short, right? Because look what happened every time price came to this 50 SMA, we had a nice rejection. So it's just for added confluence. Go to the 4-hour time frame. What happened every time price came down to this 20 SMA? We had a nice rejection. Again, you could use this for confluence. Even for the 50 SMA, look at this. Nice rejection. You could use it for confluence, right? You never want to use it alone, but you could use it to, again, look at the probability of where your trade could actually head towards. Now, if you see, let's say, both moving averages cross on one time frame, right? Check the daily and see what those moving averages look like. If they're still red over blue, then typically you're going to be trading bearish and you're going to be looking to go bearish. Now, it's a little bit harder to use moving averages in a condition where the market is consolidating, right? But if you look at it in a condition where the market is actually trending and making higher highs and higher lows, as long as price is trading above both of these moving averages, you shouldn't really be looking to go short unless you're trading at a major level, which you could then wait for more confirmation, right? Now, on the lower time frames, price is going to be pulling back and the moving averages may cross at point in times. Again, you always want to refer to what the 4-hour time frame is doing. Once the 4-hour time frame starts showing red over blue, then that's when you would look to actually change directions. Notice here, once price crossed over red over blue and price started to reject the 50 SMA, we started actually making lower lows from that point in time. So that's how you'd want to use the moving averages to your advantage. Now, I don't typically use the RSI all too much, but when I do use them, I look at it for divergence, and RSI divergence is really what I use the RSI for, right? So I'm going to try and find a good example here, which we can actually I'm trying to find a good example of RSI divergence so we could really pinpoint what RSI divergence really looks like. And it's just, you're not always going to see it very clear, but there will be times like this one where it is very clear and very obvious, right? So first of all, same thing, you're going to go to indicators, you're going to type RSI, and you're going to have relative strength index there. Now, all the RSI tells us is when the market is in an overbought or an oversold condition. Now, just because I say that, it doesn't mean that when price is overbought, it's going to go down. It doesn't mean when price is oversold, it's going to go up, right? We really only want to look at the RSI for divergence because it increases the probability of a trade. Typically, when there's strong RSI divergence on a trade and you're trading at a level of support, right, or resistance, it increases the probability of the trade. And that's something I like to see, especially with double tops and double bottoms. So with double tops, you're going to look for bearish RSI divergence. With double bottoms, we're going to look for bullish RSI divergence, right? So RSI moves based off of the candle closures, right? So we could see here that price did a very nice and clean rejection of the same exact level before continuing to trade higher, right? What we see here is price make an even double bottom. But on the RSI, what we could see here is that price actually looks like it made a higher low, which we know that's not the case on the price action chart. That is bullish divergence, right? So notice how price closed evenly here, right? And if we align our cursor, what we see on the RSI is that we have a low here, which is an oversold condition. And then here we have price actually make a higher low, which is sign of bullish divergence, which is simply signs that we may see more orders go bullish, and we may see the speed of those orders come in very quickly. Now, when it comes down to my RSI settings, I like to use a little bit more like extreme settings. So we're going to do a 7 length, and we're going to do an 80 and 20. So the upper band is going to be blue, we're going to go 80, the lower band is going to be 20, and we're going to go red. And that's how we would use RSI. So let's take a look at an example, see if we see bearish divergence here. So notice how price is approaching this resistance level, and notice how this high is obviously lower than this high in terms of the close. Remember, we're looking at the candle close. But on RSI, our first high being here is a lot higher than our second high, showing us bearish divergence. Notice how it's not the same story. That is bearish divergence, and you can expect price to reject and continue in the opposite direction. Now, just because you see bearish divergence doesn't mean it's always going to happen. Notice where price was actually flat here, price was higher. Notice how this first high closed lower than this second high. On RSI, it looks like the second high closed higher than the first high, right? That is another example of bearish divergence where it just didn't work out in your favor. And you have to know that really we're only going to use RSI at our major levels after we see some form of a double bottom or double top, where we have a nice double bottom like this, or we have a double top like this. That's when we'll whip out the RSI and consult with the RSI to see if there's any divergence. Anyways, guys, I don't think this was a lesson where we needed to go too in depth on the indicators. But again, when you see like situations like this, you only want to use indicators for trending conditions. And on top of that, right, what we could see is the hour time frame breaking above the 50 SMA here after rejecting a major level. So we could potentially see price go up. But really, like if you look at the trend overall, notice how long price was trending downward, and then price only started making higher highs once it actually broke above the 50 SMA. Once price breaks above the 50 SMA or under the 50 SMA on the 4-hour or especially the daily time frame, you definitely could look to actually change in trend. But typically you'll see that a lot sooner with the 4-hour time frame, right? So notice here how price is actually making higher highs and higher lows on silver for quite some time before breaking under the 50 SMA, lower high at the 50 SMA, and then lower lows and lower highs continued. So again, really the main time frame you want to focus on the SMAs is the 4-hour and the daily time frame, and you look for that SMA crossover in terms of changing trend. If you would like to use only the 50, that's totally fine as well. That's up to you. But I kind of like to have both on there at times. Anyways, everybody, I will talk to everybody in the next video. Hopefully this was a simple lesson that everybody can understand.